Now let's address some numbers. It's been a mixed showing for Newgen software in Q3. Revenue growth has been quite subdued, but profit after tax has seen a 27% rise year on year. Virender, Jeet, CEO of Newgen software, is now joining us. Virender, good morning. Thanks a lot for joining us. I'm just going by the quote that you had for Q3, that the quarter witnessed 20% year-on-year growth in subscription revenues. However, several of these orders have long gestation, leading to a deferment of revenues. Can you explain this deferment of revenues?
Good morning, Anuj, and thank you for having me on the call. You're right. I think this has been a good quarter for us, and we continued the growth momentum across all 3 quarters this year, unlike last year, which was slightly more, impacted by pandemic for us. What has happened, we seriously over some time have started shifting from the license-based business to a subscription-based business for most of our orders. And while mature markets have been always on the subscription, even on the emerging market side, we have started moving to subscription. So most of the orders which we book now in these quarters, current quarters, don't realize revenues. So they get deferred because the gestation cycle for these cases they take 3 to 6 months to implement, and then the subscription and the license revenue starts triggering in. So we had a healthy order book. We booked around 17 orders. But unlike our previous model, when a lot of revenue of those 17 orders would have come in the quarter, now this is going to come over next 2-3 quarters.
Virender, for the 9-month period, revenue growth is 16%. The fourth quarter historically is the strongest. In constant currency terms, what can growth look like? What can you end the year with? What the exit rate?
Well, thanks, Prashant. So, right now we have, as you're right, we have done around 16.5% growth on constant currency. I think right now the situation, it may be 0.5 or 1% different from this. So it won't be too much of a difference. We do expect to close this year stronger. As you're right, the Q4 is generally a strong quarter for us. But as I said, some amount of shift from license to subscription base will move down the top line for a few quarters till it starts building up. But we do expect that we can, come back to our historical growth trajectories of 18 to 20%. And that's what we targeted for this year. And we are trying to be as close to that.
Okay, you have highlighted in the past, just to take this forward, this shift to SaaS that could impact the near-term growth. In the past, I think you've said that your tie-up with global system integrators, GSI, is growing, but the revenues from these deals are taking very long to fructify or to come through and to scale up as well. How long do you think it could take? I mean, you of course have said that it could get worse before it gets better, but just to understand what the texture, of the earnings could look like over the next 1 to 2 years?
So, the GSIs for us are a very important channel, and we have started developing it over the last 1 or 2 years. And we have been operating out of emerging markets for a long period of our history. And last 3-4 years, we have started shifting to mature markets. And in mature markets, we have been focusing on typically tier 2 markets in banking and financial services. With GSIs, we have tried to make a conscious shift to focus on Fortune 2000, and that's a new market. So we think as our historical growth rates of around 20%, we should be able to do organically, and the GSIs should give us an upside. But having said that, though the funnel is looking good, the activity out there are slightly longer gestation cycles for these orders, and also the deal controls are more between the partner ecosystem as they are pursuing much larger deals. So for us, slightly the predictability of that revenue right now to build on this base is slightly difficult. What we are planning is that in next 9 months to 18 months time, this should start establishing a strong base as a subscription revenue start piling up and the order flows become consistent. Then we should be able to push our traditional growth rates beyond our traditional growth rates of 18 to 20%. It should add another 3-4% to our top line growth.
Virender, please explain to me, how do we read your margins? Because, they're all over the place. Quarter by quarter, there's absolutely no trend at all. I mean, it can be 11%, 26, 37, 33, then back to 14, 25, 28. So it's just a bit of a cyclicality involved here. I mean, if you could explain to us what's happening here.
Yeah, Arjun, I think your frustration to understand this, I think we share the same. And I think this is not to do with margins, it's to do with the cyclicality in business. Yeah, so, We have a lopsided revenue historically. Our Q1, Q2 are pretty small, and Q3, Q4 are substantially large, and the costs are very flat. They don't change substantially. So that's why most of the margin expansion happens in Q3, Q4, and it has been a history for the company for the last 9-10 years. Our keenness to shift to subscription-based businesses and to reduce the dependence on the jerky license business is one of the reasons we are trying to make it smoother. It has become a bit smoother, but last year was completely unreasonable margins because of the costs which were optimized, because a pandemic brought some kind of uncertainty and everything was more on prevention of or what you call conservation of cost cash. So it had very unnatural margins of up to 38% of EBITDA in Q3. We have given a long-term guidance that we should be able to deliver around 24 to 25% EBITDA and roughly around 19 to 20% PAT consistently. The business on its own is a very high gross margin business. Roughly around 55% of our business operates at 90% gross margin because it's a license-based business predominantly and does not have any revenues associated with that. So we can generate much higher margins in the business. But our, the outlook is predominantly to stay around 19-20% of PAT, and then aggressively look at rest of the thing to invest in sales and marketing and R&D to further push up the growth. So right now, you're right. It is going to be lopsided for some more years or some more quarters, and then as we are fixing or going to more subscription-based businesses and more mature market deals, it's going to get smoothened out.
All right. Virender, thank you very much. Good speaking with you. Appreciate you joining us with that insight, and good luck going forward as well. That's Newgen 626. By the way, ASX Nifty futures have dropped a little bit more. I think we're down about 1/3%. That's 50-60 points. This is a bit more deeper into the red as compared to when we started about half an hour back or even before that. There's 9 minutes to go for the pre-open session. We'll take a quick break here. We'll get you trading ideas. Mitesh and Sudarshan will be with us for that in just a bit.